When starting an options wheel strategy, it's possible to initiate it by either selling a cash secure put or selling a covered call. I think the simplest and easiest way for a new option trader to get started with a wheel strategy is by using existing shares to sell a covered call. Be sure to watch this entire video because I've got a surprise reveal to share. Join right now to get access to my option trading alert notifications by clicking on the link in the description below. I've found that using the option wheel strategy for part of my option trading is a great way to amplify my profits. If you're not familiar with the wheel strategy, the easiest way to describe it is that it combines two different option trading techniques. First, you sell a cash secured put, and that's followed by selling a covered call, and the output of one feeds the input of the other. I've got a video available that explains the details behind a wheel strategy. It describes and explains what it is and how it works. I'll leave a link in the description below. Many traders often describe starting a wheel strategy by first selling a cash secure put. But that doesn't always have to be the case. In fact, in this video, I'm sharing how I start my options wheel strategy by first selling a covered call. So if you're unfamiliar with how a covered call works, let me take the next 60 seconds and walk you through a very simple transaction just to illustrate what I'm talking about. So there I am on the left, and I own 100 shares of stock in company ABC. And by writing a covered call, I create a covered call option contract, and I use my shares of stock that I hold as the underlying security. By setting a strike price, I specify how much I want to receive for my shares, and I also set an expiration date on the contract itself. Then I go ahead and make the order available for sale. If there's an interested buyer in my contract, they're going to end up paying me the option premium. The premium allows the buyer to retain the rights to the contract itself. Now at this point, there are two outcomes or results that will occur from issuing this contract. So let's take a look at them. So in outcome number one, my shares will actually get assigned to the buyer. And that's because the market price exceeds the strike price. And so the buyer is going to exercise the contract, and they'll get my shares of stock. And then in return, they're going to pay me the $61 per share that I asked for. In outcome number two, the contract itself is going to expire worthless, and that's because on the expiration day, the market price is below the strike price, and so that contract is null and void and it's worthless. So even though it's worthless, guess what? I still retain the premium. Now that I've explained how selling a covered call option contract works, I'll share a real-life example. Here's the actual transaction record from my account history. Now, just to back up, I actually owned 100 shares of Enphase Energy, stock symbol ENPH. And here you can see I sold a covered call for ENPH with a strike price of $172.50 and an expiration date of March 11th. Now I submitted this order on March 7th, and it was filled that morning at 6:40 a.m. Pacific time. Now at that time, the premium was $4.20 per share. So when my option contract got filled, I received a total premium payment of $420. So now with the covered call sold, let's see where I'm at on the option wheel. So I've actually sold the covered call here on March 7th, and now I need to wait for the expiration date, and hopefully the market price will finish above my strike price so that my shares get sold and assigned to the buyer of my option contract. Now let's use a daily chart and jump forward in time and find out what happened with my option contract on the expiration date, March 11th. And just as a reminder, the strike price for my option contract was $172.50. And as we look at the chart, we can see that the share price closed at $171.07 per share, which is below my strike price. So as a result, my option contract expired worthless. Now, because the option contract expired worthless, I get to keep the $420 premium that I collected, and my shares that were reserved as collateral, I get to keep those as well. So as a quick recap, I sold a covered call on March 7th. And then on the expiration date of March 11th, this option contract expired worthless. But what am I going to do next? Well, in my simple option trading method, I'm going to sell another covered call. So I'll repeat the process and sell a new covered call using the same shares of stock I have, and then I'll collect more premium. So that's exactly what I did. I used those same shares to sell another covered call. And here's the actual transaction record from my account history, where you could see that I sold a covered call for the same symbol, ENPH, at the same strike price, $172.50, but now with a different expiration date. I'm going to go another week out, so this is March 18th. Now, I submitted the order on March 14th, and it was filled that morning at 7:18 a.m. Pacific time. And at that time, it was paying $5.90 per share. So when this option contract got filled, I received a total premium payment of $590. and that showed up as a credit deposited immediately into my trading account. So here we see that on March 14th, I sold another covered call using my same exact shares. Since today is only March 15th, we'll have to wait and see what happens on the expiration date. If the market price finishes above my strike, my shares will get assigned. And if the contract expires worthless again and I'm not able to sell the shares, I'll just repeat the process over and over again. Well, now it's time for me to reveal the surprise that I mentioned earlier in this video. I've actually been using these same shares for the past 34 days to sell 6 different covered call options, and I've received $1,875 in premium payments. Here's a worksheet that I put together to document my covered call activity for this option wheel strategy that I've been working for the past month. Now, of course, this trade required me owning 100 shares of stock before selling the covered call option contract. But what if I didn't own the shares? What could I have done? Well, I could have just sold a cash secured put in order to acquire some shares at a discounted price. And in that situation, I'd be starting the option wheel strategy here, selling a cash secured put at step number 1. But I'll save that video for another day, where I start off an option wheel strategy by selling a cash secure put. You can get immediate access to my trade alert notifications by joining my Simple Trading Room community. Be sure to use the special link that I've included in the description below so you can join in on the action. There's one last thing before I end this video. Now, making profits and generating an income from option trading is a great thing, but keep in mind that all gains made from trading are considered income and are subject to applicable tax considerations. So every month, I save a portion of the profits that I earned in order to pay for my federal and state taxes. So please consult with your CPA, licensed financial advisor, and or tax preparer regarding the tax liabilities for your unique situation. If you're still watching this video, I just want to say thank you so much. I really appreciate it. And I also want to wish you good luck and lots of success with all of your trades.